Welcome to Take a Stock on Tuesday, the 22nd of August, 2023. I'm here with Cashmere John. John, it's warmer today, and you're wearing like your jumper. What's going on there?
Yeah, I'm wearing a t-shirt.
Are you?
Yeah.
Oh, okay. All right then. Fair enough then. Fair enough. And
Arms.
by the way, by all means, hit that subscribe button if you could on Vox there on our channel on YouTube. We are taking a break, a little break for a while. And if we get lots of subscribers, we'll come back. But if we don't, we won't bother. But so hit that subscribe. Are we coming back? Definitely?
Yeah, we definitely come back. September.
Okay.
Early September.
And in fact, that's part of the reason, I'm looking at this, let's look at the stats here. And I'm sure we were having an off-air discussion there about the stats of market returns, for September to April and from April to the rest of the year. And I was under the belief that the returns are better generally in the winter months of the year. That's from mid-September onwards, or especially from November, December up to April. And then it does sort of roll over a little bit. But what are you saying? It's not the case, you think?
No. There is definitely seasonality. But my observation would be that it's not consistent. So, yeah, you generally have stronger months later in the year. I mean, you have things like the Santa Claus rally, which sometimes comes.
Has he been? I know, for the last few years.
Yeah, quite. It would have been exactly. So there is seasonality for sure, but it's not consistent. So, if you want to play the market with market timing and try and take advantage of that seasonality, you can never be guaranteed in any one year that it's going to work the way you think it is.
Yeah.
And generally speaking, I alluded to this old adage the other day. Time in the market is much more valuable than timing the market. Timing the market is very hard. And even the best investors, generally shy away from that strategy. Yeah,
and that's those stats are all based, of course, on indices, and literally, it's a stock market. It's a market of stocks, ladies and gentlemen. That means there's plenty of stocks in there where there's plenty of opportunities. There's always cheap companies. There's always an opportunity. And in fact, they say that sort of July, August generally is not very good. I've had a very good July and August, actually, as far as the market's concerned. I've had quite a few nice, decent rises, which have been massively oversold. So it's done okay for me. So, yeah, you shouldn't generalize on these stats. Stats is on the indices, not on individual stocks.
There's also how you interpret it. I mean, the adage was originally selling may go away, come back on St. Leger's Day. That's sort of late September, but the Americans look at October. They call it the Halloween effect. So, I mean, when we look at the performance of these various timing strategies, I think often it's been comparing like with like.
Yeah, that used to be the time. Basically, that went back to when old investors, traders were super rich and they could afford to take the summer off.
That's
and.
Right.
And literally, they go, right, we'll come back for St. Ledger's, then we get out of the market.
Lies. Oh, blimey. While he's doing that, lies and damn statistics, going back to a Mark Twain quote. You can make stats tell you any story you want.
Sorry, I'm sorry here. I think the fallers today, Ocado, Associated British Foods, Melrose Industries, Unilever rises on the FTSE, is Fresnillo, of course, Silver, Glencore. It's a lot of miners today. So
I mean,
sneezing.
You generally get a bit of a bounce back when you've had some down days, and obviously, as we spoke about the other day, the down days are very much based on the fact that China's economy is slowing rapidly.
I can't stop sneezing. I think I need to take some time off.
Oh dear! But, bless you.
Yeah, by all means, get involved in that survey. Do you pay any attention to seasonality and selling may go away, come back today?
What do the results say so far? What's the general consensus on that?
I don't know. I don't know. Let's have a look here. Let's have a quick look. So I've got no, 87% pretty much.
Yeah, general consensus, which I would agree.
Good. Okay. Subscribe there. By the way, if I can get through this. Right, Steve on comment says, Justin John, please keep doing your show. I've learned so much.
The sneezing show.
Yeah. Thanks, he said. Would really appreciate your thoughts on
this is the best one,
yeah, you can tell us live. Your thoughts on base resources. Let me just say one thing. we're not into resource stocks that much. You know?
I don't hold any. I mean, I do keep an eye on them, because obviously resources, commodities are an important part of the global economy. This is quite a big one. I'm just looking at that top line. What is it? Australian mineral sands.
Heavy mineral sands, and I never really understood this, but
I'm looking at the forecast and they're going backwards, and I don't know why.
I looked at that. That's worrying. The forecasts are dropping in revenue. I don't know why that is. So maybe that's why it's come off. And in fact, what did Steve say? Steve did say share prediction of 37, currently 10 pence, and a 30% potential dividend yield. That's pretty wide. If they're giving cash back, are they winding down operations? What's happening there? Because sometimes that can happen.
That would be the only explanation. I need to have a look at this one in more detail. But I mean, the first thing I did, as I mentioned, is my approach is quickly go to the numbers and the most recent news flow, but looking at those numbers, and the first thing I saw was the top line revenues, forecast to contract quite sharply in the years ahead. So I want to go away and have a look at that in more detail.
Yeah. And just looking at sort of forecasts here, analyst rating. So they got one buy analyst rating on this, but they are showing a strong buy, 96% up from where we are now at 93 pence. So I don't know what that is, but if you look at the chart, I'll show you the chart. It's in a bit of a downtrend, and I did put this on. You can see here, previous support here, pretty much at 11 pence, and it's broken down here. It's trying to rally off that once there, came back up, broke down below that level is 10 pence there. It's trying to break back above that now, but it's struggling. So, but it is above 50-day moving average. But I like to see it get above this, previous support. Back here, 11 pence and above 200-day moving average, and then you may see something going in the right direction. But I said what I didn't understand was revenues going down over the next few years. So unless they're returning money to shareholders because they're winding down operations somewhere, I don't know. There has been a reduction in the resources in the last recent update, but we're not we're not over resource stocks that much. All right, so if you can tell us what's happening, that would help us.
I will have a look at this because it seems like a curious situation.
Okay. By the way, also someone asked us to look at Anexo and what is it? Bodycote. Boy is the Anexo. Now, Anexo, I've had them on the podcast quite a few times, a while back, and they did have that claim against, Volkswagen, a diesel's emissions claim. I think they're expecting to get a lot more for that. But
the business is nice. It's a good business.
Well, they come out with results today, and then interim results. And let's have a look through them.
Yeah, basically what it does is hire vehicles for no fault accidents, and it's moving into various other spaces as well. I mean, it's obviously doing the emissions claims, but it's doing essentially social housing claims against poor properties, that sort of stuff.
Yeah. So these are the results today. There's a H1 77. That's right. And profit before tax 15 million. And someone did say, why are they valued at this? Remember though, that's seven. I always look at enterprise value because it's a sort of more accurate valuation. If you're going to buy a business, you want to know how much debt and cash they've got. So enterprise value does that. It adds the debt on because of course that's the cost and removes the cash. Now, if you do that, then they've got about 57 million quid worth of debt and they've got about 7 million quid worth of cash. So really the enterprise value is 121 million. But still no. I mean, that's, if you look at I was looking at the profit after tax is about 10 million. So if you just double that for the full year, 20 is there 20 million, that's still a PE of 6. So it's not like it's still quite cheap if they're growing. Like I said, maybe there's a bit of worry about that debt, but
it's the debt. So that will suppress the the sort of value of the equity. Because as you say, the underlying business is worth 150 million quid, but half of that belongs to the bank in essence. So what the company's doing, and I think the shares are up quite sharply today.
Yeah, there we are. They're up 10% today. Yeah.
And what's happening is that the company itself recognises that debt has become an issue, and so what they're really trying to do is focus on cash collection. So they're really trying to deliver only the most profitable bits of the business or the most profitable business. And that's having an effect. So if you look at the numbers today, you'll see that cash collections up, debt, it's moving in the right direction. And And yeah, so you go, 15.7 net cash from operating activities. So, really significant improvement there in cash flow, and cash is what matters, ultimately at the end of the day. It's the only thing you can't really lie about when you're putting the accounts together. Business here is good. And actually that focus on cash collection is addressing the problem that is probably suppressing the value of these shares.
So they're reducing that. They do say they're addressing, net debt, significant reduction in net debt, 61 million. It's down from 74. So they are looking at that and they are addressing that. I understand that. As far as the challenges, I quite like that. I mean, it's come down a long way. I mean, look at that. It's come from 150, even higher than that previously, 150 say down to 66 pence, and it's broken the 50-day moving average, and now it's above a previous high of that range. So that's quite nice. So hopefully this may be the bottom. Who knows? It may bump along there, but it's that's definitely broken out of a range. You can see that in rise today. Whether some people will be taking profit now, I don't know, but that's a good start on the chart.
And there's some, as I say, the new business line, the housing disrepair, big issue. A lot of people in poorly managed rental properties. So there's a lot of business to come that way. Obviously, it didn't get quite as much in the VW case it wanted, but it's got a class action against Mercedes coming up. 12,000 people involved in that. And as I say, the core, hire business is being refocused to be much more cash generative. And so if that debt keeps coming down, the value of the equity will rise.
Okay. Another question. I don't know if you know much about Bodycote. So it's a 1.2 billion pound company.
Yeah, big old engineer.
Engineer there, and what he done, and. So I have a look at this. I've done, the results came out a while back. They were very good. Where are the interim results? 6 months. Here we go. So all seems to be, going in the right direction. And I even thought maybe it's the outlook, because the share price, if you look at the share price, it hasn't really, it's come down off after those results. And sometimes it travels towards that, of course, expecting that. But, I did look at it. I thought maybe the outlook is bad, but the outlook isn't bad.
No.
They're quite confident in the outlook. Normally, you can see when a company releases these seemingly good results, because they're backward looking anyway. They're 3 to 6 months out of date, and they're looking forward. That's what people care about, and they give a gloomy outlook that shares can take a hammering. But the outlook isn't that bad. And they say, looking beyond 2023, the board remains confident in the group's prospects for continued profitable growth. So, any thoughts on this, Johnny boy?
Yeah, it's a nice company. I mean, the UK the UK market has plenty of these, very specialist niche engineers. I say niche. 1.2 billion sounds big, but in the grand scheme of things, it's fairly niche. When you think of the size of someone like Siemens over in Germany. But this is it's a nice company, and what's the valuation looking like? I mean, I don't think it's massively expensive. 15 times. I mean, it's not cheap. Coming down though as earnings rise. Borrowings again are a bit of an issue, but on the way down. And that's probably holding the shares back. I'm just looking at this, the last reported borrowings. What were they at the interim? So I'm looking at 100 million on an aggregate overview.
I'm just looking at the analyst rating here. Is an average here target price of 25% upside. So it's £8.2. There's one hour analyst saying it's a sell at 6 quid is giving it, so that brings it down. But one of the analysts has got £10, so 56% up. So of course, with the big companies like this, you're not going to get a huge upside, but the chance that upside is more likely, a higher probability than say a micro cap where you're going for say 6,000% or something. So because it's a lot more risk involved in that. So but I would say it's here chart wise, it's not a bad thing, because if you look at this, it has been sort of moving up, higher lows pretty much. It's a little bit worried. It's touched 200 moving average here. So so I don't know, maybe have a bit of patience with it if it's not doing too badly, because it does tend to have these sell-offs, like you say. It comes down, touches the 200 moving average, and moves back up. So maybe it'll do that. Who knows?
Yeah, I mean, it's got like all engineers, a bit of exposure to China, which I think might create a few dishes. The exposure to Germany is obviously sort of indirectly exposure to China and the economy. So I guess, sometimes you get really good companies. I'm just thinking forecast P 13, which, in the current market, I mean, it's, in the sort of, in the context of history, that doesn't sound expensive, but at the moment it's not cheap. So, compared to the US, it's very, very inexpensive. And that sort of speaks more of the UK market than anything else. But even very good companies And I'm not saying Bodycote isn't; it is a good company. But I'm just thinking back, sort of just before the sell-off really happened. You had companies like Spirax Sarco, and Oxford Instruments, and all of these companies, Judges Scientific, real specialists. And their valuations, their ratings got massively ahead of themselves. So you were talking sort of 40 or 50 times earnings for these companies that were very good, but sort of not growing anywhere near quickly enough to justify those sort of ratings. And what you have seen is massive ratings compression. What I suspect is that it will take time for anything like that level of ebullience to come back. And so good company. Look, I mean that's a decent uptrend there at the end. But I wouldn't expect it to sort of motor away from here.
Yeah, and you can see. Let's be honest. I mean, from June to the results there to August, it did rally a little bit. So maybe it's just coming off from that, people taking a profit. Okay, let's look at the front page of Vox. Eagle Eye partners with major Canadian retailer for loyalty program revamp. Eagle Eye. I have looked at these before. And they're seemingly quite cheap. I thought. No, I didn't really look into them. I thought, it didn't really. What do they do, John?
Software, so it's sort of loyalty programs mainly for. So this news today is with a big Canadian retailer, online and physical store presence. There you go, Hudson's Bay. But they recently did a deal with Morrisons to introduce a loyalty card, long overdue, I hasten to add. I have no idea why Morrisons hasn't really gone down the sort of club card route more aggressively. Probably why the performance of that supermarket was so bad for many years. Working with John Lewis on a revamped loyalty program. So yeah, that's what they do. And they do it well. And the company's forecast to grow quite quickly. So let's say
they're forecast to go up 43 million for the year, top line revenue up 36%, adjusted EBITDA up 32%, closing net cash. So obviously good to see cash going up there. That's nice.
And this again, it comes back to that point we made earlier on. Cash is king. If you see companies generate cash, then and I say generating, I don't mean raising cash and then putting a higher net cash position. Cash from operating activities. Then you've got something interesting to look at. And then I'm looking at the forecast, and the growth is pretty punchy. It's sort of into 23, 36% turnover growth, really quite substantial levels of pre-tax profit this year, from sort of cusp of break even, and then really continues to grow much more quickly than that beyond. So yeah, interesting. Yeah,
look at that, right?
Poorly covered.
Yeah, look at that. So in the last 651 days, it's done a 466% rise. Now, let's look at this compared to AIM, for example, right? And I've got this on here. In the last 715 days, AIM has gone down by 44%. So I don't know if it's on AIM. Is it Eagle Eye? Is it on
I assume it is, yeah.
LSE, no LSE.
Is it? Okay, sorry.
Anyway, what I'm saying is it's in that small cap space, sort of 159. But I said, look at that. That is a huge drawdown in almost 2 years now since the top of the market, done 45% down pretty much for an indices. That's quite scary. But it's nice to see something going the opposite direction.
But I guess
against trend,
I guess this goes back to that thing we've been saying for quite a while, and that is that in a bear market, everything gets sold off. Very few companies that aren't affected by a sell-off. But that does create opportunity, as you've said on several occasions. And the question is finding the gems, the hidden gems, the diamonds in the rough, because a lot of stuff that's sold off is sold off because it's bad. But there will be stuff that's sold off not because it's bad, just because it's part of the wider selling pressure. And this looks like one of them.
Yeah, this is just a notification on Seed. I always look at charts that are hitting recent highs. That is Seed, which is an investment company, pretty much. It's been talked about quite a bit on Twitter, but it seems to be breaking out there. If it gets above that, like I said previously, it's been here before, but if it can get above that, that's quite good. Quite good news there. Seed Innovations.
I thought you said C for a minute there, because they had
seen
it.
Seen it.
Seeing machines.
In fact, let's look at those, because they have had some news out today, and so C, and in fact, I think it's one of the most read on the front page.
It is definitely.
Well, the thing I worry about this is that the key financial highlights is reported revenues, all good growth, 57 million, 58, 49% increase. Okay, analyzed recurring revenues up, strong balance sheet with cash at 36.8 million. Okay, that's good. So I went back to the last set of results. Remember that 36.8 million. That's in June. Okay, so if you go back to the results back here, and you think, okay, where's the last set of results? Where's the last set of results here? Scroll down. Hang on. A lot of directors buying by the look of it. Half year financial report. Strong balance sheet at 52. Oh, okay. Well, it's gone down pretty much in 6 months. It's gone down by what, 16 million. So
but this is, this is high.
I do like the company. I mean, they do you want to explain what they do? Because I can't.
It's basically driver monitoring. So it's not autonomous driving, but it's using AI to basically keep an eye on drivers and make sure they're not falling asleep at the wheel or doing anything stupid. And they work with fleet customers and cars for sale to retail. They work with sort of public transport networks, and there's a nascent aviation division, but it's basically a safety product. And it's new. I mean, my car's 5 years old and it doesn't have it. I just get a little beep to tell me that I've been driving for too long and I ought to stop for a little bit.
Do you know what I did have a while back? A while back, not the car we got now, but literally 2 cars back. I think it was a Golf actually. But it's like I used cruise control a lot on the motorways. I think if you see how erratic drivers are, everything should be autonomous now. Humans are idiots. Absolutely. I'll put my sort of, cruise control on and I'll put it on, and I'll admit this, I'll put it on at 10% minus 2. Okay. So I know 10% plus 2 is the speed limit pretty much. 79. So I got 75. I'll 70. I'll say 70. 70, right? And I will have people, right, overtake me, and I'll be in the middle lane, so come back, come into my lane and slow right down. Hang on, I'm in 70. You've just done 80, you passed me, and you're slowing me down, and I have to brake now. You idiot! And you get and also every time going up a hill, cars generally slow down. Going down a hill, they speed up. And you realize that's what causes crashes. The inconsistency of distance between people, braking. We need automation. I used to have a VW Golf. They used to do all that. I put in cruise control and it would speed up and slow down. You keep like 100 yards distance between the next car. I used to love that.
You're making a case for making a bull case for seeing machines here.
Yeah. I love that. Humans are idiots.
And I suppose that could be the summary investment thesis for seeing machines.
There'd be no crash on the roads if it was all autonomous, because you'd have like 200 meters in between each other, doing 150 miles an hour, all cars could, because you wouldn't have any erratic braking, because that's what causes crashes. People at the backside of their cars, slowing down, speeding up. You wouldn't have that with autonomy. You wouldn't have that, honestly. They're a lot safer than humans. Humans are idiots. Just put your car on cruise control on the motorway and see how erratic people are. They'll speed up, overtake you, pull in front of you, brake almost. What are you doing?
I'm going to make one observation about what you've just said. Middle lane. Get out the middle lane.
No, I'll go in the slow lane. I will go in the slow lane. I'm saying you just see that more often. People just pulling in, overtaking you, slowing right down. What are you doing? Or they'd be right at your backside. They slow down, and so it's just erraticness.
Yes. Anyway, seeing machines. So this is it's really motoring again. No pun intended. Profits due 25. Pre-tax profit 2025. Yeah, it's got to spend big to get there. This is
that's it. It's got to spend more
stuff.
But
it's making massive progress. I mean, cars on the road. There's 1 million cars on the road with this technology in them now. And as you know, it's 140% year-on-year jump, and the annual volume increase is 640,000 vehicles. So, lots and lots of opportunity here, because there are obviously a lot more cars on the road than that. And you can retrofit this as well. So there is I like it. So it's nice.
Yeah. Well, do you know what? It is an erratic chart. It's really erratic, but it needs to get above that 200-day moving average. It tends to get above that and come back down. So when you have a company like this burning a lot of cash, it's quite worrying, because if you look at it, they did 32 million in 6 months. That cash is pretty much they're going to need to raise more cash unless they really cut down on the spend. So
or if that top line really starts to motor.
Yeah. Another one actually. Yeah, go on.
No. So the top line, what we got, sort of 55 million this year, 62.5 a year after, 87.5 the year after that. So you're sort of getting a bit exponential there if it hits its forecast.
Well, Mirriad, another one. I do like the tech and all that stuff, but I mean, the top line isn't growing that much, and
it's going backwards. Well, no, it isn't going backwards. I tell a lie, but I mean, it's gone backwards in its key market, which is the US.
Yeah.
They've pulled out of China, so there's big strategic review to save money. Pulled out of China to focus on the US, which makes sense. But the problem they've faced is that the US advertising market is in a bit of a mess at the moment. We've seen that with S4. We've seen that with oh Christ, who was the other one? I can't remember. Tremor, the ad serving provider that had some terrible numbers the other day. It's made some sensible steps that arguably it should have made earlier. So, it's moved to programmatic, so it takes a lot of the manual grunt out of selling this stuff. It's really increased the number of agency partners it has. It's working with Microsoft to develop this into an enterprise product. And this could deliver some growth, much more rapid growth later this year. But shareholders have had to be very patient with this one.
Yeah, I mean, look at this rise here. Back in May, they announced some kind of results, and they had like a top load of cash. Brilliant!
Well, they were trying to sell the business.
Yeah, and the cash was worth more than the company. That's right, and the cash was more than the company pretty much. So it rallied like 400%, and now we got back down to below that. But what I did look at, if you look at the financial results, we are talking. What are we? We are to a 3 million, 4 million pound company, pretty much interim results. This is for half year.
6 million in the bank, fair enough.
Yeah.
Well. 10 million in the bank.
Oh, okay. So 500,000 of revenue. So let's say they do, let's be generous and say they do 600,000 per year. Let's say they do 1.3 million maybe. But
they do say that the second half's going to be a lot quicker. It's a seasonal market.
Let's say they do 2 million, but closing cash at the year end of 9.8 million, no debt. They have a forecast from May to August 2024. They do that. So they got a year of cash pretty much.
They've got to have a good Christmas. That's basically what it boils down to. They've got to have a good Christmas. Otherwise, they might need to be back for more money next year.
Yeah, they did say, look at that. The cash burn pretty much, they're going to get down to 700 grand per month for 12 months. And I thought, that's still 8.4 million a year. And you got 9.8 left. So you're going to have to cut something a lot more than that.
Oh yeah, I mean it's really it's such a good technology platform. It's in program advertising, so contextual advertising within a program. So it doesn't, you don't have those linear it's not like linear telly. There's no ad breaks to interrupt the viewer, and therefore the advertising, the product placement, the virtual product placement is much more effective. And they've done a lot of research with a company called Kantar, which is a media research specialist, and the results of what it does are spectacular, and that is why it works with some very, very large advertisers, from retailers, automotive, household. I like the
products. Way you hit the desk, John. Automotive, yeah.
It's just a question of it has to have a that
it has to. Well, we all want a good Christmas, don't we?
Yeah, we all.
But
this company, it matters because that cash lasts till August next year.
Here's Kickbox chart. They've it's the AGM statement there. Is it? No, AGM statement. Yeah, board update. It said franchise like-for-like sales increasing 6.8% first 17 weeks. Increase of 5.4% for like last time. The strong balance sheet of like 7.9 million. The chart is in a bit of a range. It dropped massively. Bit of a mess up with the sort of reporting there, and the CFO so had to step down. But it said that's the resistance level pretty much is 151, which is it's hovering around, broke above it, but it's come back down a little bit. So at least that is to me is the end of a downtrend. How far up I can go, I don't know, but it seems like an end of a downtrend there. Have you had any of their cakes, John?
I haven't. I've never seen one.
Okay.
Never ever seen one.
Egg free, aren't they? So there we are. Paul Hill's got an interview there with the guy there. Suk Chamdal and Michael Botha. Looking quickly at the most followed Apta. They've raised some money. Powerhouse Energy. In fact, that's the most read as well. They've raised £1 million. This is one of the 10 bags I missed out on. This Audiboom and Algo Blockchain was 3 companies I got bored with. I was convinced they were going to go to the moon. As soon as I got out, they did. So,
the reverse Justin selling indicator again. I had a quick peek at Powerhouse, and actually,
it's promised for so much for so long, John.
Yeah, do you know what? It brought to mind something we were talking about last week, which was Ectech. So Ectech doing waste to syngas, and its ultimate aim is to not operate the plants that its technology is in, but provide technology and service to them, Powerhouse seems to be going the other way. So they tried to build a licensing model for its waste to electricity technology. And now it's decided, or earlier this year, decided to operate the plants itself. Sounds expensive. Sounds very expensive. And what did they raise? £1 million? Yeah.
Well, exactly. I mean, that's as far as I'm going to go. You know, let's look at it. By the way, a couple of comments here quickly. Matthew Roberts, any more ideas, John? Somero, I bought when you sold. Facilities ADF, I bought after the strikes. You'd highlighted and got quite a few under 40, about 35% up overall. 5 weeks. Oh, ADF is doing well, is it?
Yeah, do you know, I've been looking at that. So when it was really sold off quite heavily. You know, I was I must have been about 30% down on that position. And yeah, there you go. Look at it bounce back. I wish I bought some more.
Literally, Matthew's jumping on your coattails here, John. It's annoying that. Don't say anything. Anything else you bought? And Somero, how's that doing? By the way,
I'm out, so I'm looking at it. It's probably languishing still. Where is it? Still down about £3 thereabouts.
I see. It's about that big sell off, and then but that support level there, pretty much at 350.
Yeah, that chart's got to turn around. And as I said, I need to see some trading catalysts there. I do. It's good company. I heard somebody mentioned that there's some worries about competition. Okay. I would have thought the biggest competition is a bloke with a big scaffolding board walking backwards. Some big wellies.
So Matthew says, any more boring companies that have sold off? This is where the value is in my opinion. No, any companies that sell off potentially. I've got an eye on one right now, and I sold off massively. And I'm not going to tell you what it is yet because I want to see the trading update. But it's in a very good area. But I think it's now cheap. And when you get in there, you can see the forecast, profits of this company looking cheap. If they confirm that, it's going to work. The TJ09 says best UK dividend stock, one pick each. I'm not going to pick one. I'm going to pick my fund, which I've got. IUKD is ticker. It has all the highest yielding FTSE 100 and 250 stocks in there, and you get paid quarterly, and it's an ETF, so you can buy and sell that, like a traded stock. So IUKD is that. It's a BlackRock fund. But John, any individual stock that is dividend pay you'd like or not?
I mean, in my portfolio, I'm just looking at it. H&T pays a nice dividend. That sold off a bit since I bought it, and I do think it's somewhat misunderstood. It's known as a pawnbroker, but it's actually a very, very good business. Pawnbroking, it's got that sort of reputation of being a bit grubby, but this is a very, very well-run company. As a pawnbroker, it's also a retailer, but with a twist. And I said it does foreign exchange as well.
Alan Jones, in fact, is obviously more research than us on seeing machines. He said, see cash disclaimer on RS. Working capital increased due to the timing of the Guardian inventory deliveries, leading to an increased level of inventory and receivables at the 30th of June 2023. Yep. And his inventory levels are sufficient to support demand for H1 full year 2024, which will unwind along with receivables. So they use more cash to buy more stock, basically.
That's the kind. But it is cash. We've always said that scaling is a difficult thing to do. That cash is obviously there to help seeing machines scale. And to be honest, I mean, looking at company with 35 million quid on the balance sheet or dollars, cash is not my immediate worry there.
Phil says, Rightmove, any guys, if the stock gets pulled down because of the current negativity, then would it be interesting if you chaps buying back shares over the last 15 years? I did hold Rightmove a while back. It went up a little bit, and then I get bored with it. So I would say go for smaller.
Fabulous company.
It's a fabulous company. It becomes a market leader, but like I said, it doesn't get hit. You don't see many opportunities. I mean, it won't get hit that much. I would look at say maybe its competitor on the market, which has been hammered a bit more. And like I said, they've got a decent amount of cash. What are they valued at now? On the market, for example, they are a 44 million market cap. They've got literally, how much cash? They've got literally 10 million in cash, 12 million in cash, 11 million in cash. They are going to be profitable. And I think they're going the right direction. But I tell you what
I like about them on the market is, they're obviously, you would look at them and think, oh, they're just a, Rightmove wannabe. But they're actually developing a really nice suite of products, what I would sort of, call prop tech, to support the industry, to support landlords, all that sort of stuff. So I think there's a little bit more going on the market than perhaps the market gives them credit for.
Yeah, another one is lots of areas around that area as well. Eleco, which is a software company for building companies, for design and all that stuff, they'll have an uptick in. I think Paul Hill owns those actually. But things like that, that you wouldn't see. You wouldn't. It's not directly involved. But I mean, there's also the house builders. I mean, I was looking at Gleeson. Even at these levels, I think I was looking at the what is it? The forecast here, pretty much, and they were saying 50-odd% by 46% forecast there. One analyst, though, no, 5 analysts, and they're saying average of like 46% on that at least.
You're battling horrible sentiment with that sector, though.
But I know, but do you know what? That's when to buy, though. That is when to buy. That's absolutely when to buy. I mean, if once the sentiment starts changing, that'll be up like 20%, 30%.
But I just I just have this feeling, and it is a feeling, but also based on some of the data we've seen from the housing sector.
I've got a feeling.
But I just got a feeling this could rumble on for some time. This disquiet in the housing market. There's a lot of things that need to be resolved. Housing affordability is bad. We haven't seen the end of the cost of living crisis, and it's just a political hot potato. Housing is a political nightmare. So there's a lot of shenanigans to come there, I suspect.
Let me just before we go for our break for a week. Have you seen this? This is about sales growth. This is very important. I did tweet the Bank of England. I don't know why I did that, but just pause for heaven's sake. You say on your website it takes 2 years for interest rates to kick in, and we haven't even seen 2 years of rate rises yet. Things are rolling over. Okay, sales growth at supermarkets slowed in August, not only down to the weather, but if you look at this, even on a volume basis, it went down 3.8%, right? And this is NIQ, this is the most up-to-date data you can get. This is actually data right now, or looking back in the last month, not like the Bank of England looks back 3 months. But so he says, head of retailer business inside, he said, despite easing inflation, most consumers remain pessimistic about their financial situation in the coming 3 months, with 60% anticipating they'll be severely or moderately impacted by rising living costs. We haven't seen the start of the cost of living crisis yet. And the Bank of England keep on ratcheting up the... Are you nuts? Just pause, wait, before you kill businesses off. I
do wonder, this is where you sort of get another risk, that actually, people are buying less, but obviously spending more. That sort of kind of is supportive of the retail industry, but will people get into the habit of just buying less?
This
well,
you realise you don't need to spend all that much money. It's quite elastic. There, as people start once things start coming down in price, they buy more. I expect. I've always been a consumer being or animal. Do you know what was very interesting actually? I realised the core inflation, right? It does include cigarettes, alcohol, food, energy. It does include rent, doesn't it? Core inflation. And yet, what the Bank of England don't understand is that's what they look at. That's the figure they look at, core inflation. So what the Bank of England don't understand, what they do understand, why they're acting so stupid, is if they put up interest rates again, landlords with mortgages have to put up rents. That plays into core inflation. They're not going to help it at this stage anymore. It's going to make it worse.
Landlords are pulling out the market. At a pace. I
know, but I think
the analysis.
Get a mortgage.
I mean, it's funny. I think someone was looking at. I think the analysis came from Savills, and I think they were looking at capital gains tax receipts to work out how many landlords were selling up. Obviously, second properties where you're liable for capital gain. Then you have the sort of double whammy: is that landlords sell up, so there's more people chasing less housing stock, rental stock, and so landlords can put their rents up, not just to cover their bills, but just because there is demand. So again, it sort of goes back to why the housing market is such a it's so important in the UK.
Absolutely.
And why I sort of would tend to still steer clear of anything where there might be political intervention, which is why if you want to get into the housing market, read the platforms like Rightmove and OnTheMarket are a much safer place to be.
Just 2 quick stories here, but I mean, look at this: the public sector borrowing below forecast. Everyone's talking about this. Oh, it's below forecast. That's good, but if you delve down and look at the figures, they're not good at all. Total debt now in the UK is 2.58 trillion at the end of July. Right, that's 98.5% of GDP. But still below 100%. That's good, isn't it?
I thought it had breached 100%.
And me, but look at this.
This is what I'd heard.
The government paid debt interest of 7.7 billion, the highest on record in July. That's their interest payments alone. 7.7 billion. That's another reason to keep the sort of interest rates down. But don't worry, if you're a CEO of a FTSE company, you won't be struggling too much. The average pay there was 3.91 million.
It's okay.
CEO of a FTSE 100. Yeah.
It's okay. We've got trickle down economics.
Yeah. Well, it's not trickling down that fast.
It isn't trickling down at all because it's a fallacy.
I know, exactly. That is nuts. Purple bricks. Yeah, purple bricks. Rightmove is the same old time. Away from just boring driving. My driving is not boring. It saves lives, actually.
Middle lane driver. Middle lane driver.
No,
middle lane. Justin. There you go.
You realise how if you just do me a favour, and we're away for a week. If you're travelling around, put your car on cruise control on the motorway and see how erratic human beings are. And you, in a few years' time, will come back to the thing: why do they even let humans drive cars? They're insane. Anyway, it's time for a break. I think a week's break. I'm taking us. Thanks very much.
We'll be back on what is it?
Yeah,
the 4th. I think it would be.
When we're back to work properly.
Monday, the 4th of September.
Yeah, remember the 4th. By all means, pass it around, hit that subscribe button, and we'll speak then. In a few weeks' time. Bye-bye.
Have a good holiday. See you later.